In this video, I want to show you how you can predict the next candle, the next market move at every point in time. The reason for this video is that you need to know the right way to know what the market will do at any point in time. When you are able to anticipate the market move, it will help you to be at the right side of the market at every point in time. Now, I've made an introductory form of this video in the last video I made before this one. But why this video is more important is that I'm going to be showing you short examples of those candle range theory patterns. The candle range theory states that every candle is a range and it has its own power of 3 on a lower time frame, and that if you zoom into the lower time frame, you will see that the range forms between the high and the low on a lower time frame of the candle range. Okay, and the range consists of the continuous phase of accumulation, manipulation, and distribution. A particular candle on a higher time frame, and this is the lower time frame range of the same candle. When you move to lower time frame, this could be like a D1 or H4 or H1 time frame, and this could be like a M30 or M15 or M5. Okay, it's the candle range, and it consists of accumulation, manipulation, and distribution. Okay, and now this is both the bearish scenario and the bullish scenario. Let me do a very brief recap. So we said that the candle range theory consists of accumulation, manipulation, and distribution, which is the power of 3. Okay, the power of 3: accumulation, manipulation, and distribution. For a bullish scenario, this is the candle range. As we said, the market opens with an accumulation, and the accumulation means when the market makers are actually accumulating orders for the day. All right, and when that happens, it appears as a consolidation to the retail traders. Okay, accumulation looks as a consolidation to retail traders, and they target or they aim to trade the breakout of that consolidation. And if in this case now, in the bullish scenario, when the accumulation happens to the downside right here, the retail traders will enter the trade at the breakout and place their stop loss as above the accumulation. All right, and but that mostly is a manipulation, in the sense that is a fake move targeted to take out all these retail stop losses. Okay, is a fake move targeted to take out retail stop losses, and then when that happens, the market is seen to move in the opposite direction of the fake move, and all retail stop losses are taken out, which is called the distribution, and then the market would now close here with another consolidation. Okay, and now for the bearish scenario, this is the candle range. That is the candle range on a higher time frame, and the market opens with an accumulation, manipulates up, and now distributes right there down, and then close with another consolidation. All right, so now we have 3 CRT patterns, 3 candle range patterns, and the first one is the standard 3 candles pattern. Okay, for the standard 3 candles pattern, we have the bearish, and the bullish. Okay, now in the bearish case, there's a range candle, and the range candle high and the range candle low. Now this is the sweeping candle. The sweeping candle sweeps the candle range high, and then this candle will now distribute down. Okay, that is for a bearish scenario. Okay, that is for a bearish scenario. For a bullish scenario, we have a range candle here, and now the sweeping candle sweeps the candle range low with a wick, and then this candle now distributes the market in the opposite direction of the sweep. Okay, most times the distribution phase happens in opposite direction of the sweep. Okay, so in this case, I said that the first candle sets up a range, just as I said here, and then followed by the second candle that takes out the liquidity of the first candle. And there's liquidity at every candle range high and low. So the sweeping candle takes out the liquidity that is here. In this case, the sweeping candle takes out the liquidity of the candle range low. It's a bearish scenario. The liquidity is taken out at the candle range high. Okay, so the second candle, what does it do? The second candle takes out liquidity, which is called the turtle soup, and then the third candle breaks out of the candle range in the opposite direction of the liquidity sweep. This is the third candle. It breaks out in the opposite direction of the liquidity sweep. This third candle breaks out in the opposite direction of the liquidity sweep. So this is the standard 3 candles pattern of the CRT pattern. The second candle range pattern, okay, is the inside bar candle range pattern. And the inside bar candle range pattern, we have the range candle followed by an inside bar, then the sweeping candle, and then the distribution candle. Okay, so the first candle sets up a range just as we saw here, and now followed by the second candle, which is an inside bar candle, and then the third candle is a sweeping candle that takes out the liquidity by a wick, which is so soup. This is a sweeping candle that takes out the liquidity at this candle range low by the wick. And then we have the fourth candle, which breaks out of the range in the opposite direction to the liquidity sweep. Okay, that is the second CRT pattern. The third CRT pattern is not so much different, just that there are multiple candles formed before the candle range high is broken to the other side. So the difference within this multiple candle range pattern is that it takes a longer time to complete, because there are multiple candles that are being formed. We have the range candle right there, the sweeping candle, and now we have all these candles that are being formed before the market breaks out to the other side in opposite direction of the liquidity sweep. Okay, all right, so this is just the range, the multi-candle range pattern. All right, so now let us move on. There are two pro tips I've always told you about, and always trade away from the liquidity sweep for the drawn liquidity of the candle range high or low. Now what I mean is that if this is the liquidity sweep, you should trade away from it. That is your trading. So your trade, you should be looking at entering trades somewhere around here in opposite direction to the liquidity sweep of the range candle. The liquidity of the range candle is swept on the downside. Your trade should be to the upside. If your liquidity is swept on the upside, your trade should be towards the low side. Okay, we're going to see clearly when we enter into the chart very soon. Now, I will say the best place to enter the trade also, based on the CRT pattern, is at the manipulation phase or second range candle. Okay, so this is the best place to enter a trade here. Don't enter it. Is not you could actually see entries at the distributive phase or this candle, but is far better you enter the trade somewhere around here at the second candle or the manipulative candle or the manipulative phase for a higher risk to reward ratio. Okay, now for the entry techniques, if the high of the candle range is swept, okay, if the high of the candle range here, the high of the candle range is swept, for this candle is swept, if the high of the candle range is swept, so you have to go to the lower time frame and look for a shift in market structure or the break or this change of character, and then enter a sell trade at the return of the variable PD array like the order block or FVG that caused this change of character, and you now target the low here. Okay, this is the liquidity sweep to the upside. Now this is the range candle, so you are targeting the low of the candle range. Okay, for the sell scenario, we're going to see it in no too distant time on the chart. For the bullish scenario, if the low of the candle range is swept, you need to go. The low of the candle range is swept here. This is the candle range high and low. If the candle range low is swept, okay, you need to go to the lower time frame and look for a shift in market structure or change of character, and then enter a buy trade at the return to the available PD array, which is like the order block or FVG that caused the market structure shift, and target the high. You target the high here. This is sweeping candle. You target the high of the candle range as your take profit. Now for take profit and stop loss, so the first take profit is at like 50% of the candle range, or 1 to 2 risk to reward ratio should be your first take profit. 1 to 2 risk to reward ratio, or 50% of the candle range. Now the final take profit, which is like 100% of the candle range to the upside or to the downside. You are placing your stop loss few pips away from the high of your supply zone or the low of your demand zone. Okay, for your setup time frame and entry time frame, if you are using the monthly time frame as your setup time frame, then it's advised to use the daily time frame as your entry time frame. Your daily time frame as your setup time frame. Your 4 hours time frame should be your entry time frame. Okay, 4 hours time frame as your setup time frame. The 1 hour time frame should be your entry time frame. You're using the 1 hour time frame as your setup time frame. Then the 15 minutes time frame should be, or even the 5 minutes time frame should be your entry time frame. If you're using the 15 minutes time frame as your setup time frame, then the 1 minute time frame should be your entry time frame. Okay, Now for the trading sessions timing, very important. So for me personally, the time to look for setups, I look for my setup between 6 a.m. to 9 a.m. London time, which is approximately 2 a.m. to 5 p.m. New York time. Now trade entry, when I enter my trades most times, is 10 a.m. to 2 p.m. London time, or which is like the 6 a.m. to 10 a.m. New York time. And I tend to close most of my trades 2 p.m. to 4 p.m. London time. So I want to show you chart examples. Let's look at the chart examples on the bearish scenario and the bullish scenario. Three candle patterns of the candle range theory. Okay, so now look at this. Just take a look at this. You can see this is the three candle pattern, and this is the range. This is the candle range. The first candle is the candle range. This is the sweeping candle. This is the candle range, sweeping candle, and this third candle here is the distribution candle. Okay, so let us this we are in a 1 hour time frame, so let's just play it to see how that would work. The first thing is to let's put our range high and our range low. Okay, so that's the range high and range low. So let us do a bar replay to see it. So you can see our range high. These are range high and range low, range high, range low, and this is the candle range. Okay, that's the candle range. All right, so now let us go down to lower time frame to see. We are on a 1 hour time frame. Let's go to lower time frame, like five minutes time frame. So on a 5 minutes time frame, you can see the candle range here. So let us play and see how when we have our sweeping candle. So you can see, oh, we've had our sweeping candle right now forming. So you can see here the candle range high has been swept. So once the candle range high is being swept, so we now have to look for our break of structure. So let's look for our break of structure. We're playing this to have our break of structure. Okay, so we now have our break of structure. So our break of structure has happened there. So after seeing our break of structure, we now need to mark the supply zone that broke structure, the supply zone of the FVG. That's the PD array, but in this case is the supply zone. You can see here this is a supply zone that created the break of structure. So we need to mark that supply zone. So we'll mark that supply zone that created the break of structure. So after marking the supply zone, now let us put our take profit. Let's put our take profit and stop loss. Okay, just few pips above the supply zone for our stop loss. Okay, so let us play to see how it played out. So the market has come to mitigate our supply zone right there. So our supply zone has been mitigated, and now let us see. Now for take profit, I told you for take profit you can target 1:2 risk to reward ratio, or the midpoint of the candle range, and then if in this case your final TP should be at the other side of the candle range, which is the candle range low. All right, but most times, as I said, price can come down below even the candle range low if you're in a sell scenario, or the candle range high if it's on a buy scenario. So let us continue to see how it played out. Okay, so you see how our take profit has been hit. So you can see how this setup played out so beautifully. This is the candle range. This is our sweeping candle, right? Sweeping candle on a higher time frame or on a lower time frame. You can see this, our sweeping, our candle high was swept. We now have our break of structure, the mitigation of our supply zone. Okay, so let us move back to higher time frame to see how the three candles has formed. Okay, for higher time frame, you can see here this is our candle range, That is our sweeping candle right there, and this is our distribution candle. Okay, I hope that is clear. Now let us now look for a buy scenario. Let's look at these three candles right there. We have candle, the range candle, the sweeping candle, and the distribution candle right there. So let us use a replay to see how this actually worked. Okay, so you can see here now. Let's mark our candle range high and candle range low. So this is the higher time frame, 1 hour time frame. So we need to step down to the 15 minutes time frame, so or the 5 minutes time frame. So you can see the candle range. This is the candle range on a lower time frame. So let's play to see when we're going to have our sweeping candle, and then look for our break of structure and other entry confirmation. So let us play and see. So you can see in this case, you can see our candle range low having swept right there. So let's continue so that we can know when to have our break of structure. So we continue to play. So here we have our break of structure. How do I know our break of structure has been created right there? As the market has broken structure, we now mark our zone, which is the demand zone that created the demand zone, or the bullish order block that created the break of structure to the upside. So let us mark it. So that's the demand zone that created the break of structure to the upside. We can as well mark our. So let's mark our profit target. Okay, stop loss somewhere there. Okay, so this is our take profit and stop loss put in place after the break of structure. And then let's now see when we're going to have our return to order block. Let's see when we're going to have our return to order block. Let us play to see. Good. So you can see there, we get our entry here, and our first take profit was just at the midpoint of the candle range, and the final take profit was at the candle range high. Okay, so you can see how that played out so perfectly. Mitigation was right there into the order block. So now let's move again to the higher time frame of 1 hour to see those three candles, how they were formed. So you can see here, this was our range candle, this is our sweeping candle, and we told you we entered on the sweeping candle here, which is the manipulation candle at the week, somewhere at the week right there. And now this is the week. So these are sweeping candle or manipulation candle, and this third candle is our distribution candle. So I hope with these two examples you really got it clearly how the candle range theory can play out on a higher time frame and a lower time frame. Okay, so what is more important is that when you mark a candle range candle, you go down to a lower time frame, and when on the lower time frame, once you see the sweeping candle on one side of the candle range high or low, then you need to trade in the opposite direction of the candle range sweep. Okay, so like in this case, the candle range low was swept, so we are going to trade in the opposite direction towards the other side of the candle range. Okay, had it was this point that was swept, then our trade will now be to the opposite direction, and we'll target this low as our final take profit. So I hope this is clear. So you can just go to your chart pack, test this strategy very well, and look at other occurrences of them, and with time and practice you will get a better understanding of the strategy. Okay, so if you're here to subscribe to this YouTube channel, please kindly do so, and give this video a thumbs up if you found value from it, and share with your friends and other traders so that they can benefit from this video. So if you want me to also mentor you one-on-one, I have several people I'm training and helping to become better, even regardless of how long you've spent trading the forex market. If you want me to help you to become a better trader, I can help you on one-on-one mentorship. I take you by the hands and help you to become a very profitable trader. I identify your deficiencies and help you to correct them. and help you to become a very good trader and a profitable trader. You want me to mentor you, send me a DM. My DM is in my free Telegram channel, and the link to our free Telegram channel is in the description box of this video. If you like to join our free Telegram channel, do not fail to do so, because in that free Telegram channel as well, I share free setup and analysis that can help you to improve your trading. So till I come your way next time with another useful content, do have a wonderful day ahead. Bye.